Hey, good morning, guys. Thanks for taking the time to dial in. We've got a lot of material to cover, so I'm just going to jump right into it. We're going to start with what I think is a picture of what everyone's biggest fear would be, which is what soybean oil looks like this morning. Everyone's biggest fear is that we're going to rally, and then all of a sudden the price is going to drop out from under us, and we're just going to be left wishing that we had been more aggressive in selling, right? And so that's exactly what longs are feeling like in soybean oil. So this is basically a vertical implosion over the last 10 days or so, from 79.20 all the way down. Now, there's lots of things that are driving that, right? One is Biden's talk about the relieving gas tax, and maybe opening up some more refining capacity, and doing some things to help bring in diesel and curtail some of the fuel shortages. But another thing that's happening is just the maturity of the move. And we've been talking about this for quite some time, that this bull market started in 2020, and it started at a time when it shouldn't have. This whole thing began when oil went negative. Um, uh, we had a 3 billion bushel corn carryout forecasted, or right at it. We had basis levels that were imploding. We had markets at full carry. And then we had COVID when we turned off ethanol, and for no reason on this earth, we held $3 a bushel. And honestly, we should have traded much lower than that. 250, $2, maybe even put a one in front of it in some places. In North Dakota, in June of 2020, in North Dakota, there was a lot of corn trading hands for less than $2 a bushel, $1.60, $1.75. And there's really no reason that our futures held the way they did. And so we've talked about this for several weeks, that if corn is ever going to break its all-time high, it really should do it right away. And if it doesn't, then we can be left surprised. So we want to be open-minded to what's happening in other markets, especially markets that led the way, like this one. So I'm not telling you this to put fear in, but I'm just asking that we be open-minded and realistic. Because when we look out our windows and we see corn curling, and you hear stories on TikTok and Twitter about weather damage and pollination issues, you're only hearing the bad. And wheat is a good example here. We've heard lots and lots of horror stories about wheat, terrible yields, people in western Kansas not receiving any rain whatsoever. And yet in the northern part of the state and the eastern, and a huge portion of it, are harvesting all-time record yields. And you hear nothing about that. And I'm even hearing some yields here locally that are really surprising. In fields that everything around it is 20 and 25 bushel. I'm hearing some 50s and 60s. And if you dig deep, you can read some of those surprises. So then you see wheat, and you wonder, well, if the harvest is so bad and there's war happening and there's all these things going on, why is wheat coming off? Well, it's because people are starting to harvest record crops, and that's going to put more hedge pressure on it. So we got to be open-minded, because and realize and trust that the market knows all. And I mean, that's the fundamental and basic premise of why we look at charts, is because we believe that the market understands and knows. And so we want to be deferential to them. Okay, so we're going to jump from here. We're going to go look at soybeans. Let's look at new crop beans real quick. They're obviously following suit, right? In fact, I think this is the same day that bean oil topped, and we've just been working ourselves lower. We did not like this gap yesterday at all. We gapped from 1536 and a half, and we gapped, and the open yesterday was down at 1529. Right, that's a pretty large gap, 7 cents, and then we made no effort to fill it. fact, from the time we opened, we never even traded inside the gap territory, which is bearish. And we also gap below our slow line, which is a major sell signal. And then the other thing that I really didn't like at all is that we gap back below this entire shelf, right? All of this action right in here that has served as resistance for from February all the way through, and then we finally broke it. Now we've gapped back below it. So I think that that's a negative development in soybeans, and something that probably should be monitored. Now I'm going to switch to a spreadsheet, because I think that beans have got to work a little bit lower, but I don't necessarily think that it's safe to say, oh, the top is done and the bull story is dead. And let's talk about why. All right, here's our balance sheets, and I really would just want to focus on corn, and then we're going to jump to our corn charts. So this is what the USDA is telling us, okay? They're telling us that our ending stocks are going to be 1.4 billion bushels, and that we're going to plant 89.5. And we're into that time of year where our June 30 quarterly stocks report, it comes out next Thursday, as does the WASDE that tells us what the USDA says is going to be our planted acreage, harvested acreage, and a yield indication. So lots of information coming to us next week. So I want to look at what happens to our carryout under different scenarios, right? Because we all know that this number, on the bottom, the big one here, is the number that really matters. And at the end of the day, it's the stocks to use. It's how many bushels do we have left over relative to how much we used that gives us our pipeline carryout. You know, how many days or months can we survive without a new corn crop? That's what this number is really telling us. So the USDA has us pegged at ending last year at 1.485 billion bushels carrying in, and they had raised that in June. So that trend is a little bit bearish, okay? Now, I've taken all these numbers right here and put them straight over here into our neutral case. If the USDA does nothing, then this is what they'll publish. They'll publish 89.5 million corn acres. So what we've done here is we've taken, we've added a million of increased acreage, and we've taken off, we've added 1.5 and we've taken off a million, okay? So that is a pretty nice range of acreage. I don't think it'll be outside that. I think if it is outside either one of these, then that would be a shock to the market, right? And then we talk about yield. So what I want to show you is the sensitivity that we have to yield. So I'm going to equalize all of these, put them back to normal, 14570, okay, and 14570. And now let's look at yield sensitivities, okay? So if we drop the yield, the USDA is using 177. They had come off from 181. If we drop the yield to 175, and lose acreage, you can see the impact to our balance sheet. Both of these would end up being bullish relative to our market, right? So whether we increase acres or decrease them, a yield move with demand being equal is actually going to be implied as bullish. Now, what do they do with ending stocks? Do they leave them the same, or do they trim them? Right? So if they increase acreage, they could trim ending stocks and say, oh no, we have less, and we'd still be bullish. And that would be a way for them to mute the upward reaction, right? Because if this is if this is all the way down at 1.3, then this would drop too. So let's do that. Let's take this down to 1.300. Now you're below 100. Now you're below $1 billion. They're not going to do that because that would be too bullish, right? If we drop our ending stocks, if we drop our yield to 175, if we lose acres and we have less, which is, by the way, what the basis has been telling us, with $2 over in Western Kansas and with spreads being strong on the front month, the market's been telling us that this number is probably too high, so they should trim it. The information that we've gotten from the north, right, with preventive plant and just the planting issues might imply that we'd have less acres. So if those two things happen, it becomes very, very bullish. And what if we have a yield like we had 2 years ago, right, where we drop it down to 168, which is, by the way, like top 5 or 6 all-time record crops. If that happens, then we're apocalyptically bullish. Now, on the flip side, if we actually have ending stocks the way they were, and demand gets trimmed, let's drop this to 14.2. Sorry, 14.2. So if we trim demand by 300 million bushels because the USDA says, oh, hey, we're good, right? We've done our job. We've curtailed some exports. China's not going to come to the party and buy more corn. So we've got plenty, and we have plenty of old stocks, and we plant more acres, and weather we expect to be normal. So we're going to put a 179 in here, and bam, you've got a 2.1 billion bushel carryout, stocks to use at 15%, and this is your bearish scenario. Increased acreage, high yield. This shouldn't be a surprise to anybody, right? But the sensitivity is where it's really important, because if this drops to 165, then you're still really tight. So we can have increased acreage, lots of old stocks, decreased demand, and still tighten our carryout if we get hot and dry. And I think that's what we're seeing in the market, this huge swing of potential yield and carryout results, right? I mean, that is massive. So the market doesn't know what to do with it. So it's creating all kinds of it's creating all kinds of volatility. Now let's look at corn. So I've got 3 charts in front of you. This is July corn over here. You've got September and you've got December. So it's the 3 front month corn contracts. And it's trying to digest that range of information that we just gave, right? And remember, at the beginning, I said, hey, we've got to trust the market to be right, that it knows what's happening. It's figuring it out for us. And so we're looking for clues as to what it's currently thinking. And I think that there's a small divergence on here that is worth talking about. So if you look at the rally that started on June 1st, that peaked out last week, and you put a Fibonacci retracement, which is these 2 bars right here. Here's 38%, 50, and 61.8. You can see that July corn held right at 61.8, but September and December fell through it and closed below it. And so I think what that's telling us is that the market is buying into the story that the acres are there, and that the yield and that the weather is not threatening enough. And so a break below here, it probably is going to accelerate all the way down in the 670 September, 650 range into December. Now, well, that sounds really scary, right? And really, really bearish, and we should all rush out and we should sell everything that we have. I don't think so, because there's still too much time left, and the USDA might kick out one of those bullish scenarios and push the balance sheet in line with what the basis in the cash market has been telling us. And so I don't think that we can ignore that possibility. We always talk about going into a major report, the point of max pain. At what price does the market need to trade to make it the most difficult for the most people? And when you trade to extremes right before a report, that makes it easy, because you fade them, right? So if we implode the corn market in the next week and we take it down to 650 or 625, I think that becomes a no-brainer. You have to trade the long side going into that report, because the bullish scenario is too bullish. I mean, it's all-time highs and way beyond them. On the flip side, if we break out to all-time highs and we're trading, $8 next week, I think it's pretty easy to fade that because you can say, well, we haven't killed the crop yet. We probably need to sell it. So where's this market going to trade? Probably about right where we're at. We may take a quick run down and then put it right back up into the 725 area on December. We may just sit right here and not go anywhere for the next week. I don't think that the volatility is going to be continued as strong as it has been the last 2 days, because I think that yesterday and Friday were the days that the funds started their positioning. So I really think that we just got pushed around and that we're just going to sit tight. And so I believe that the right course of action is to sit and be patient. Now, if you're unwilling to take that risk, then I think the best thing that you can do is either buy some short-dated August or September puts. Those range between 20 and 25 cents versus the Decembers that are trading at 60 cents. Those are very, very expensive. So you can buy some short-dated puts to get yourself some protection in the event that we do collapse this market, or you can sell cash and buy short-dated calls that give you that keep your upside reopened, or you can just choose to do nothing, and we can we can trade from whatever the information that we have is. I do think that next week's going to be volatile, and I think the volatility of the week of the 5th is going to be extreme as the market tries to digest whatever numbers that the USDA decides to print. I don't think there's any way to get clarity ahead of it. I think the market is just telling us that it doesn't know either, and that's why we're getting these wild swings. So I think the best thing you can do is make yourself comfortable, right? If you want your downside gone, then let's get it gone and let's own calls. Or just put some puts on and don't worry about it. And then look at it on July 10th, and we'll know a lot more at that point. That's probably your best course of action. Whatever you do, don't try to overtrade it. Now let's look at wheat with our remaining time here. Wheat is obviously in has some problems, and it's starting to look a little bit like soybean oil, right? Just basically a vertical, just a straight vertical drop. And what's driving that? Well, it's increased harvest pressure. It is yields that aren't quite as bad as what was expected, and the talk out of the Ukraine dealing with humanitarian corridors and bushels seeming to flow out of Ukraine through Russia and out into the world. None of that's done yet. I don't know if that's happening or if people are just selling the rumor of it. And if they are, then usually we'll forge a low right ahead of that. I don't think that wheat is completely done. I don't think there's been enough chart damage, and I think it's all eyes on corn moving forward. So if you have some protection on wheat, I think that's great. If we're down again today and we come challenge the $10 area, I think that's where you want to look to re-own it, unless we get a big reversal today. And this is where you want to look for re-ownership, because I don't think that story is fully complete yet. Now the caveat to that is oil. If crude oil and bean oil all have topped, and we are actually done going up because of government policy or just global market action, then it's possible that all these markets top first. All these markets top simultaneously, and I think beans would be the ones that would lead the way. And certainly that is not a flattering picture right here. So that's why I think it's okay to go ahead and get your downside removed. I think it's prudent because the risk is growing. Now, I don't think any of these are great specs to the short side because of the upcoming reports and because of the volatility that'll come with them. So I think you got to be really careful from that side. But from a risk management standpoint, certainly the way we're set up, no question that the downside is growing, and protection should be thought about. All right, that's what I've got for you today. There is significant risk trading futures and options. and you should only do so in light of your own financial condition. If you have questions or want to talk through positions, please give us a call. We are happy to help. We will talk to you next week.